McGraw-Hill Audio presents The 4 Pillars of Investing, Lessons for Building a Winning Portfolio by William J. Bernstein. Read by Chris Ryan. Introduction. I didn't start out my professional life in finance. My original training was in the sciences, and later in medicine. Practicing physicians, among whom I still count myself, have a richly deserved reputation as miserable investors. The conventional explanations for this are that our practices are so demanding that we don't have the time to do it properly, or that we're too egotistical to take professional advice. In fact, neither is the case. Learning how to invest properly doesn't take an inordinate effort, and I don't find most of my colleagues overly egotistical. Medical practice is a profoundly humbling experience to anyone with a breath of intellectual honesty. The best doctors soon come to the conclusion that the more they see, the less they know. The same, not surprisingly, is true in finance. The real reason that physicians are rotten investors is that it never occurs to them that finance is a science, just like medicine. Day-to-day medical practice is profoundly scientific, informed by a vast amount of underlying research. Nowadays, almost no drug or surgical treatment is adopted without rigorous trials, comparing it to other accepted treatments or placebo. In short, most physicians would not commence a treatment for so much as a cold without a good deal of experimental and statistical evidence in back of it. The most important work is reported in prestigious, peer-reviewed periodicals, such as the New England Journal of Medicine and Lancet. The key term here is peer-reviewed. Nothing appears in these high-level periodicals without being vetted first by the top experts in the field. Requests for multiple, extensive revisions are routine. Your own physician hopefully reads these top-echelon publications on a regular basis for data relevant to his practice. Unfortunately, when doctors put on their investing hats, they completely forget their scientific training. There is, in fact, a rich and informative scientific literature about what works and what doesn't in finance. It is routinely ignored. Instead of depending on the Journal of Finance, the investing equivalent of the New England Journal of Medicine, they get their advice from USA Today, or worse, from their stockbroker. Of course, I'm only picking on my colleagues for fun. In this regard, doctors are no different from lawyers, retail clerks, or anyone else. What's truly scandalous is that even most finance professionals are unaware of the scientific basis of investing, which consists of 4 broad areas, the 4 pillars of this book. Pillar 1. Theory. The most fundamental characteristic of any investment is that its return and risk go hand in hand. As all too many have learned in the past few years, a market that doubles rapidly is just as likely to halve rapidly, and a stock that appreciates 900% is just as likely to fall 90%. Or that when a broker calls suggesting that the price of a particular stock will rocket, what he's really telling you is that he is not overly impressed with your intelligence. Otherwise, you would realize that if he actually knew that the price was going to increase, he would not tell it to you or even his own mother. Instead, he would quit his job, borrow to the hilt, purchase as much of the stock as he could, and then go to the beach. The first and most important part of the book will survey the awesome body of theory and data relevant to everyday investing. Don't be daunted by this. My primary mission is to present this information in terms that you will find both understandable and entertaining. We'll learn that whether you invest in stocks, bonds, or for that matter real estate or any other kind of capital asset, you are rewarded mainly for your exposure to one thing, its risk. We'll learn just how to measure that risk and explore the interplay of risk and investment return. Over the long haul, it is not that hard to measure the probable return of different kinds of stocks and bonds. Yet even well-respected experts usually manage to do a bad job of this. Almost all the differences in the performances of money managers can be ascribed to luck and not to skill. You are most certainly not rewarded for trying to pick the best performing stocks, mutual funds, stockbrokers, or hedge funds. The biggest risk of all is failing to diversify properly. It's the behavior of your portfolio as a whole, and not the assets in it, that matters most. We'll also learn that a portfolio can behave in ways radically different than its component parts, and that this can be used to your advantage. The science of mixing different asset classes into an effective blend is called portfolio theory, and occupies center court in the grand tournament of investing. Pillar 2. History. It is a fact that, from time to time, the markets and investing public go barking mad. Of course, the madness is obvious only in retrospect. But a study of previous manias and crashes will give you at least a fighting chance of recognizing when asset prices have become absurdly expensive and risky, and when they have become too depressed and cheap to pass up. The simplest way of separating managers who would be suckered into the dot-com mania from those who would not would be to administer a brief quiz on the 1929 crash. Finance, unfortunately, is not a hard science. It is instead a social science. The difference is this: a bridge, electrical circuit, or aircraft should always respond in exactly the same way to a given set of circumstances. What separates the hard sciences of physics, engineering, electronics, or aeronautics from the social sciences is that in finance, or sociology, politics, and education, apparently similar systems will behave very differently over time. Put a different way, a physician, physicist, or chemist who is unaware of their discipline's history does not suffer greatly from the lack thereof. The investor who is unaware of financial history is irretrievably handicapped. For this reason, an understanding of financial history provides an additional dimension of expertise. In this section, we'll study the history of finance through the widest possible lens by examining just what the centuries of recorded financial history tell us about the short-term and long-term behavior of various financial assets, how, from time to time, the investing public becomes almost psychotically euphoric, and at other times toxically depressed, how modern investment technology has exposed investors to new risks. Pillar 3. Psychology. Most of what we fondly call human nature becomes a deadly quicksand of maladaptive behavior when allowed to roam free in the investment arena. A small example: people tend to be attracted to financial choices that carry low probabilities of high payoffs. In spite of the fact that the average payoff of a lottery ticket is only 50 cents on the dollar, millions invest in it. While this is a relatively minor foible for most, it becomes far more menacing as an investment strategy. One of the quickest ways to the poorhouse is to make finding the next Microsoft your primary investing goal. Only recently have academics and practitioners begun the serious study of how the individual investor's state of mind affects his or her decision-making. We'll survey the fascinating area of behavioral finance. You'll learn how to avoid the most common behavioral mistakes and to confront your own dysfunctional investment behavior. You will find out, for example, that most investors tend to become grossly overconfident, systematically pay too much for certain classes of stocks, trade too much at great cost, regularly make irrational buy and sell decisions. Pillar 4. Business. Investors tend to be touchingly naive about stockbrokers and mutual fund companies. Brokers are not your friends, and the interests of the fund companies are highly divergent from yours. You are, in fact, locked in a financial life and death struggle with the investment industry. Losing that battle puts you at increased risk of running short of assets far sooner than you'd like. The more you know about the industry's priorities and how it operates, the more likely it is that you will be able to thwart it. The brokerage and mutual fund businesses form a financial colossus that bestrides modern financial and increasingly social and political life. If you doubt this, just turn on your television and time the interval between advertisements for financial services. In the book's penultimate section, then, we'll examine how the modern financial services industry is designed solely to serve itself, and how it exists almost entirely for one purpose, the extraction of fees and commissions from the investing public, and that, in fact, we are all locked in a constant zero-sum battle with this behemoth. Operates at a level of educational, moral, and ethical imperatives that would be inconceivable in any other profession. A small example: by law, bankers, lawyers, and accountants all have a fiduciary responsibility towards their clients. Not so stockbrokers. Only after you've mastered these four areas can you formulate an overall investment strategy. Only after you've formulated a program that focuses on asset classes and the behavior of asset class mixtures will you have any chance for overall success. A deficiency in any of the four pillars will torpedo this program with brutal dispatch. Here are a couple of examples of how a failure to master the four pillars can bring grief to even the most sophisticated investors. Big-time players. The principles of long-term capital management, the firm that in 1998 almost single-handedly crippled the world financial system with their highly leveraged speculation, had no trouble with Pillar 1, investment theory, as they were in many cases its Nobel Prize-winning inventors. Their appreciation of Pillars 3 and 4, psychology and the investment business, was also top drawer. Unfortunately, despite their corporate name, none of them had a working knowledge of Pillar 2, the long-term history of the capital markets. Focusing narrowly on only several years of financial data, they forgot the fact that occasionally markets come completely off the rails, often in ways never before seen. A working knowledge of Western financial history would have warned them that their investment strategy carried with it the near certainty of self-destruction. Small investors. On the other hand, the average investor most often comes to grief because of deficiencies in Pillars 1 and 3, theory and psychology. They usually fail to understand the everyday working relationship between risk and reward, and routinely fail to stay the course when things get rough. The above two examples are caricatures. The failure modes of individual investors are as varied as their personalities. In this tome, I want to provide you with these invaluable tools, the four pillars, to avoid the kinds of failures I've listed above. I also want to expose you to the wondrous clockwork and history of the capital markets, which are deserving of attention in their own right. Arguably, the most substantive domestic issue facing the Republic is the fate of Social Security, with privatization the most frequently mentioned option. For the first time in history, a familiarity with the behavior of the financial markets has become a prerequisite for competent citizenship, apart from its obvious pecuniary value. Using the four pillars. In the book's last section, we'll show how mastery of the four pillars can result in a coherent strategy that will enable you to accomplish investing's primary aims, achieving and maintaining financial independence, and sleeping well at night. The essential mechanics of operating an efficient investment portfolio will be covered. Calculating how much you'll need to save and when you can retire, allocating your assets among various classes of stocks and bonds, choosing which mutual funds and securities to employ, getting off dead center and building your portfolio, maintaining and adjusting your portfolio over the long haul. In conclusion, although I hope that I've conveyed my enthusiasm for financial theory, history, psychology, and strategy, I'll freely admit that I've been dealt the short straw in the subject scintillation department. This book, after all, is not a bodice ripper or a spy thriller. There is no arguing with the fact that some areas of finance can be damnably opaque, even to cognoscenti. This book, then, should be consumed in small bites, perhaps 10 or 20 minutes at a time, preferably first thing in the morning. Lastly, while I've tried to make this work as comprehensive and readable as possible, no one book can claim to be an all-encompassing source of investment instruction. At best, what is offered here is a study guide, a financial tour d'horizon, if you will. Personal finance, like most important aspects of life, is a never-ending quest. The competent investor never stops learning. Pillar 1. The Theory of Investing. Chapter 1. No Guts, No Glory. I'm often asked whether the markets behave rationally. My answer is that it all depends on your time horizon. Turn on CNBC at 9:31 a.m. any weekday morning, and you're faced with a lunatic asylum described by the Three Stooges. But stand back a bit, and you'll start to see trends and regular occurrences. When the market is viewed over decades, its behavior is as predictable as a Lakers-Clippers basketball game. The one thing that stands out above all else is the relationship between return and risk. Assets with higher returns invariably carry with them stomach-churning risk, while safe assets almost always have lower returns. Today, we live in a sea of financial information, with waves of stock information constantly bombarding us. On days when the markets are particularly active, our day-to-day routines are saturated with news stories and personal conversations concerning the whys and wherefores of security prices. Even on quiet days, it is impossible to escape the ubiquitous stock ticker scrolling across the bottom of the television screen, or commercials featuring British royalty discoursing knowledgeably about equity ratios. It has become a commonplace that stocks are the best long-term investment for the average citizen. $1 invested in the U.S. stock market in 1790 would have grown to more than $23 million by the year 2000. Unfortunately, for a number of reasons, no person, family, or organization ever obtained these returns. First, we invest now so that we may spend later. In fact, this is the essence of investing, the forbearance of immediate spending in exchange for future income. Because of the mathematics of compound interest, spending even a tiny fraction on a regular basis devastates final wealth over the long haul. During the last 200 years, each 1% spent each year reduces the final amount by a factor of 8. For example, a 1% reduction in return would have reduced the final amount from $23 million to about $3 million, and a 2% reduction to about $400,000. Few investors have the patience to leave the fruits of their labor untouched, and even if they did, their spendthrift heirs would likely make fast work of their fortune. It is no accident that investors focus on the immense wealth generated by the economy and markets of the United States these past 2 centuries. The champion, our stock market, is the most easily visible, while less successful assets fade quickly from view. And yet the global investor in 1790 would have been hard-pressed to pick out the United States as a success story. At its birth, our nation was a financial basket case, and its history over the next century hardly inspired confidence, with an unstable banking structure, rampant speculation, and the Civil War. The 19th century culminated in the near bankruptcy of the U.S. Treasury, which was narrowly averted only through the organizational talents of J.P. Morgan. Worse still, for most of the past 200 years, stocks were inaccessible to the average person. Before about 1925, it was virtually impossible for even the wealthiest Americans to purchase shares in an honest and efficient manner. Worst of all, in the year 2002, the good news about historically high stock returns is out of the bag. For historical reasons, many financial scholars undertake the serious study of U.S. stock returns, with data beginning in 1871. But it's worth remembering that 1871 was only 6 years after the end of the Civil War, with industrial stocks selling at ridiculously low prices, just 3 to 4 times their annual earnings. Stocks today are selling at nearly 10 times that valuation, making it unlikely that we will witness a repeat of the returns seen in the past 130 years. The study of financial history is an essential part of every investor's education. It is not possible to precisely predict the future, but a knowledge of the past often allows us to identify financial risk in the here and now. Returns are uncertain, but risks at least can be controlled. We tend to think of the stock and bond markets as relatively recent historical phenomena, but in fact, there have been credit markets since human civilization first took root in the Fertile Crescent, and governments have been issuing bonds for several hundred years. More importantly, after they were issued, these bonds then fluctuated in price according to economic, political, and military conditions, just as they do today. Nowhere is historian George Santayana's famous dictum, "Those who cannot remember the past are condemned to repeat it," more applicable than in finance. Financial history provides us with invaluable wisdom about the nature of the capital markets and of returns on securities. Intelligent investors ignore this record at their peril. Bond returns in the 20th century. The history of bonds in the 20th century is unique. Even the most comprehensive grasp of financial history would not have prepared the 19th century investor for the hurricane that buffeted the world's fixed income markets after 1900. In order to understand what happened, it is necessary to briefly discuss the transition from the gold standard to the paper currency system that took place in the early 1900s. Freed from the obligation of having to exchange paper money for the yellow metal, governments began to print bills, sometimes with abandon. Germany in the 1920s is a prime example. The result was the first great worldwide inflation, which accelerated in fits and starts throughout most of the century, finally climaxing around 1980, when the world's central banks and treasuries increased interest rates and finally slowed down the presses. But the damage to investor confidence had already been done. Before the 20th century, bond buyers had long been accustomed to dollars, pounds, and francs that did not depreciate in value over time. At the beginning of the 20th century, investors still believed that a current dollar, pound, or franc would buy just as much in 50 years. In the decades following the conversion to paper currency, they slowly realized that their bonds, which promised only future paper currency, were worth less than they thought, producing a rise in interest rates. The result was devastating losses for bondholders. In short, bondholders in the 20th century were blindsided by what financial economists call a 1,000-year flood. In this case, the disappearance of constant-value gold-backed money. Before the 20th century, nations had temporarily gone off the hard money standard, usually during wartime. But its permanent global abandonment was never contemplated until shortly before World War I. After World War I, the change was made permanent. The shift in the investment landscape was cataclysmic, and the resulting financial damage to bonds was of the sort previously seen only with revolution and military disaster. Even in the United States, which suffered no challenge to its government or territory in the 1900s, bond losses were severe. Consider that in 1913, a U.S. stockholder or bondholder both received a 5% yield. The bondholder could reasonably expect that this 5% yield was a real one, that is, that its fixed value would not decrease over time. The stockholder, on the other hand, balanced the prospect of modest dividend growth versus the much higher risk of stocks. The abandonment of the gold standard turned all that upside down. Suddenly, the future value of the bondholder's income stream was radically devalued by higher inflation, whereas that of the stockholder was enhanced by the ability of corporations to increase their earnings and dividends with inflation. It took investors more than a generation to realize this. In the process, stock prices rose dramatically, and bond prices fell. But bond returns in the 20th century should not be used to predict future bond returns. The monetary shocks of the 20th century are among the most severe in recorded economic history, and it is more likely that inflation-adjusted bond returns going forward will be closer to the 3% to 4% rate of the previous centuries than to the near-zero rate of the last 90 years. The long-term history of stock returns. The history of stock returns is much more restricted. Although there has been active trading of stocks in England, France, and Holland for more than 300 years, it is only in the past 2 centuries that we have information on long-term returns of stocks, beginning in the United States soon after its birth. And only in the past several decades does detailed information become available from around the globe. At this point, it is important to clarify the difference between bonds and stocks. A bond is simply a loan. Most often, bonds have a sharply limited upside. The best you can do is collect your interest payments and principal at maturity. A share of stock, on the other hand, represents a claim on all of the future earnings of the company. As such, its upside is potentially unlimited. It is, of course, quite possible to suffer a 100% loss with either. If a company goes bankrupt, both its stocks and bonds may be worth nothing, although bondholders have first claim on the assets of a bankrupt company. The major difference between stocks and bonds occurs during inflation. Because a bond's payments are fixed, its value suffers during inflationary periods. It may become worthless if inflation is severe enough. Stocks are also damaged by inflation, but since a company can raise the price of the goods and services it produces, its earnings, and thus its value, should rise along with inflation. This is not to say that stocks are always superior to bonds. Although stocks often have higher returns because of their unlimited upside potential and inflation protection, there are times when bonds shine. Risk, the second dimension. The study of investment returns is only half of the story. Distilled to its essence, investing is about earning a return in exchange for shouldering risk. Return is by far the easiest half, because it is simple to define and calculate, either as total returns or as annualized returns, the hypothetical gain you'd have to earn each year to reach that value. Risk is a much harder thing to define and measure. It comes in 2 flavors, short-term and long-term. Short-term risk is somewhat easier to deal with. Short-term risk, occurring over periods of less than several years, is what we feel in our gut as we follow the market from day to day and month to month. It is what gives investors sleepless nights. More importantly, it is what causes investors to bail out of stocks after a bad run, usually at the bottom. And yet, in the long term, it is of trivial importance. After all, if you can obtain high long-term returns, what does it matter if you have lost and regained 50% or 80% of your principal along the way? This, of course, is easier said than done. Even the most disciplined investors exited the markets in the 1930s, never to return. Obsession with the short term is ingrained in human nature. The impulse is impossible to ignore. Your short-term investing emotions must be recognized and dealt with on their own terms. It is an easy thing to look at the above data and convince yourself that you will be able to stay the course through the tough times, but actually doing it is an entirely different affair. Examining historical returns and imagining losing 50% or 80% of your capital is like practicing an airplane crash in a simulator. Trust me, there is a big difference between how you'll behave in the simulator and how you'll perform during the real thing. During bull markets, everyone believes that he is committed to stocks for the long term. Unfortunately, history also tells us that during bear markets, you can hardly give stocks away. Most investors are simply not capable of withstanding the vicissitudes of an all-stock investment strategy. It's pretty clear that there's a relationship between return and risk. You enjoy high returns only by taking substantial risk. If you want to earn high returns, be prepared to suffer grievous losses from time to time. And if you want perfect safety, resign yourself to low returns. In fact, the best way to spot investment fraud is the promise of safety and very high returns. If someone offers you this, turn 180 degrees and do not walk, run.
Sample complete. Ready to continue?